You're listening to the Falcon Method podcast, the audio content accompanying our monthly investment newsletter service. If you're new to the channel, our Falcon team is made up of die-hard value investors who are dedicated to helping you navigate the chaotic stock investment landscape. In this series, we provide regular updates on investment-related topics and recap highlights from our newsletter in a more casual format. Without further ado, let's jump into today's program. Welcome back everyone in today's video. So today's topic will be a sort of follow-up on our previous video about Alibaba, in a sense that our next candidate for an analysis is no other than the Chinese technology behemoth Tencent. As valuations on the US stock market are becoming increasingly elevated in our view, we are more and more interested in looking at foreign companies, and since most of the global economic growth today is stemming from China and its rising middle class, we want to keep the most dominant Chinese companies on our radar to have an idea regarding their intrinsic value and to have an entry price in our minds to know at what level we would be investing heavily. That being said, we need to be aware of the China risk involved with such companies, like the variable interest entity structure in which both the ticker symbol BABA and TCEHY can be bought. We have written an extensive article about Alibaba, and you can find the description of this VIE structure there and the particular risks which we view as important. And we also have to bear in mind the tightening antitrust regulations of the Chinese authorities. However, we still believe that there are a few dominant companies which possess a wide economic moat and incredibly good growth prospects, and these are more than worthy for a deep dive analysis. Monish Pabrai also frequently mentions the two largest Chinese firms, Tencent and Alibaba, as being fabulous businesses, while they are similar but at the same time very different. That being said, our focus today will be on Tencent. So moving on, we are going to show you our analytical framework while researching a stock, and we are also presenting you the valuation tools we use when deciding whether to pull the trigger on an investment.
Tencent is one of China's largest technology companies. You can think of it as a digital ecosystem that fulfills everyday needs of consumers. The company has a fairly diversified revenue stream as visible on the screen. Its major services include communication and social networking, like its flagship WeChat and QQ platforms, online PC and mobile games, various forms of subscription-based digital content like news, videos, music and comics, and lastly, cloud services and financial technology. Its Tenpay payment solution enables closed-loop transactions in Tencent's whole ecosystem, and it has been adopted by many third-party partners and offline merchants.
An interesting addition is that Tencent is also often referred to as China's best venture capital fund. Tencent's investment team maintains a low profile, although everyone knows they are the 800-pound gorilla in the room, betting extensively on Chinese and overseas startups in areas such as gaming, social media, entertainment and electric vehicles. Tencent is invested in more than 800 companies, including online retailers Pinduoduo and JD.com, and electric vehicle manufacturer NIO Inc., as well as non-Chinese companies such as video game maker Activision Blizzard and social media company Snap. It's basically impossible to compute the fair value of Tencent's entire investment portfolio, especially since many firms are non-listed, so there we have no information, while it is immensely difficult to value the loss-making companies. What we are quite confident about is that there are some true gems in Tencent's portfolio. Tencent publishes the actual market value of its listed investee companies in its quarterly reports, which stands at roughly $200 billion today, which is up more than tenfold over the past 5 years. To be sure, some of Tencent's gains are on paper only and would be reduced by any sell-off that hits internet stocks or China-focused companies, especially since many technology stocks have jumped more in share price during the coronavirus pandemic than what might have been reasonable based on fundamentals. In the economic value-added framework, the EVA margin, which is simply the trailing 12 months EVA divided by sales, will serve as a ratio to define a company's moat. A 5+% EVA margin for 10 years is a telltale sign of a wide moat company, and Tencent's EVA margin has averaged 20% over the past decade, consistently above our 5% threshold, so as a result, the company's wide moat status has bulletproof evidence by the numbers. As you can see on the chart, Tencent's EVA-based profitability falls in the same ballpark as Alibaba's, but the reason we like Tencent more from a risk perspective is that its margins seems to be more stable, while it also has a better diversified revenue stream as we have showed you earlier, which is a noteworthy positive in our view.
Judging from a qualitative angle, Tencent's primary moat source is an unparalleled network effect around its massive user base. Monthly active users from Weixin, which is the Chinese equivalent of WeChat, and the QQ platform reached 1.2 billion and roughly 600 million respectively, which is quite impressive if you think about Chinese overall population of 1.4 billion people. There's also no surprise that the Weixin app ranks first in China in terms of monthly active users on Android phones and iPhones combined. Overall, we believe a wide moat rating seems fully warranted from a qualitative standpoint as well.
And now we move on to the valuation dimension. On the screen you can see our Excel model. We always emphasize that our discounted EVA models can be useful as a vaguely right rather than a precisely wrong indicator for the fair value of a company, while it is far from a precise tool. We think it's especially effective in extreme cases when the share price and the fundamental performance of the underlying businesses are largely disconnected from each other. However, when we're analyzing such businesses like Tencent, that score immensely high both on the quality and growth dimensions, our primary concern is to avoid significantly overpaying for the stock. The reason why is because the profitable growth of the company will be the major driver of shareholder returns in the case of such exceptional businesses. So anytime we could purchase the stock at or slightly below fair value, all we need to do is hold on to the position as long as fundamentals remain intact. And the reason why we use EVA instead of free cash flow in our valuation model is because this institutional level data shows the amount of true shareholder value creation, which makes it a superior measure of corporate performance in our view. That being said, the present value of a forecast for EVA is always mathematically identical to the net present value of discounted cash flows. For every company we analyze, we compute a conservative and an enterprising scenario and use those as proxies for our fair value range. As you can see, as an input, first we pull the top and bottom line explicit forecasts for the next 5 years, and based on that we compute a forecast EVA compounded annual growth rate for the period, which comes in at near 20% for Tencent, as you can see. Our conservative scenario assumes an explicit EVA growth of 12% in the period of 2021 to 2025, tapering off to 8% in 2026 till 2030 and to just 3% between 2031 and 2035. We assume a terminal growth rate of 0% since no company can forever increase its EVA, as opposed to free cash flow, EBITDA, earnings, or any other conventional accounting measure. That is because the number of additional investments where a firm can out-earn its true cost of capital, hence increase EVA, is always finite. However, Tencent could very well be one of the few companies that are able to increase its EVA for several decades, mainly resting on its early-stage investment portfolio, but this of course remains just a possibility and is far from a certainty. As a discount rate, we use Tencent's 5-year average weighted average cost of capital of 8.2%, and the resulting conservative fair value estimate arrives at $61. Turning to our enterprising scenario, we project a more aggressive explicit EVA growth of 15% in the period of 2021 till 2025, which still seems somewhat conservative in light of the 20% EVA compounded annual growth rate forecast, while assuming that the company can maintain a 10% EVA growth rate in 2026 and 2030 and 3% between 2031 and 2035. And as a result, our enterprising fair value estimate is $71. As a conclusion, our discounted EVA-based fair value estimate for Tencent falls in the range of $61 to $71, implying that its shares look roughly fairly valued to somewhat overvalued today.
Now we continue with the reverse DCF, because sometimes it can be really useful to reverse engineer the baked-in EVA growth rate from the current share price, since it can give us an indication of the market's expectations on the future growth trajectory of the company. At the current price of roughly $72 as of the 6th of July, the 10-year baked-in EVA growth rate, that is from 2021 to 2030, looks realistic in light of the company's recent performance and growth runway ahead. But to be honest, it's somewhat high for our taste, since we like buying in when the market's expectations are lower and hence the company can easily surprise on the upside.
And finally, the last step for our valuation of Tencent is that we are computing our total return estimates for the next 5 years. On the right-hand side of the screen, you can see that we have dissected the different drivers of our total return. It becomes blindingly obvious that the majority, or literally all, our total return is stemming from EVA growth. There is no buyback component since the company is not repurchasing shares. We have a minuscule dividend, which we have included. And last but not least, we have a sentiment component. In the enterprising scenario, we are roughly assuming that Tencent will trade at the high end of its historical valuation range, just as it does today. That is why that component in the enterprising scenario is rather neutral. So we have a roughly 14% total return potential. While in the more conservative scenario, we are assuming that valuation multiples contract to historic lows, and that would decrease our fundamental return stemming from the growth of the company to roughly 8 to 9%. And of the left-hand side of the screen, you basically see the midpoint value for the two scenarios. It would not be unrealistic to achieve double-digit rates of return in the next 5 years, roughly in the range of 11 to 12%. And finally, we want to show you why we think that Baba is a more interesting investment candidate at today's prices. As a disclosure, all of our analysts have positions in Baba, and neither of us has in Tencent. So basically, you can see the reverse growth DCF scenarios for each company from today's prices. And to be honest, we regard the quality and growth characteristics of both businesses to be exceptional, but rather similar to each other. And you can see that in case of Baba, today's share price implies a roughly 10% explicit EVA growth, while in case of Tencent, it's 14%. So we can already see the difference in valuation between the two of them. You can also see on the screen that we are comparing Alibaba's and Tencent's total return potential. As we've seen previously, Tencent is in the 11 to 12% range, while in the case of Baba, even after we've updated our models, it's immensely hard to come up with a realistic total return which would be below 15%. So to conclude, both of these Chinese companies are of immensely high quality and have very strong competitive position, and we would be keen to be shareholders in each of them. But in the case of Tencent, to be honest with you, we would wait for a more attractive entry price, even if double-digit returns in the long run seem very feasible from today's levels. That was it for today. We hope you got some interesting information out of this video, and see you next time. Thanks a lot for listening. That concludes the most recent edition of the Falcon Method podcast. If you like this episode, please don't forget to hit the like button and subscribe to our channel to be notified of new releases. For a detailed analysis of our monthly top 10 most attractive stocks, you can start a free trial for our newsletter under the link in the description below and get a $40 discount off the standard annual subscription fee using the code TFMPodcast40. That is TFMPodcast40 at checkout. In the description below, you can find the link to our newsletter, as well as our Seeking Alpha author profile. Make sure to check them both. If you have any questions, feel free to contact us via the email address in the description. Thanks again, and see you next time. Please note that this material is intended for educational and entertainment purposes only, and it is not a personal recommendation to buy or sell any stock or to adopt any investment strategy. The value of your investments can rise as well as fall, and there's always a risk of permanent loss of capital. Past performance is not a reliable guide for future performance. The investments referred to may not be suitable for all investors, and you should always seek personal advice from a qualified financial advisor. We can only answer questions of general nature and are unable to provide specific buy or sell recommendations or specific investment advice on an individual basis. In terms of full disclosure, we or a connected party may have an interest in the securities mentioned,